I'm Alex Tapscott. This is the first lesson of our module on digital assets. These assets are fundamental to the build-out of Web3 and are the driver of the blockchain revolution underway. You'll learn about 9 types of digital assets, and you'll also explore one or more examples of each. And you'll learn about their role in the Web3 economy. So let's review. What are digital assets? Digital assets are intangible things of value. They're defined by data created on-chain through transactions, and also data created in the real economy. And they're secured by cryptography within blockchain ecosystems. We can move, store, lend, borrow, trade, pledge, stake, and much more with these things of value, and to whatever end we desire, peer-to-peer. Cryptocurrencies like Bitcoin are just one type of digital asset. So how valuable are these digital assets? To give you some perspective, the entire crypto asset market was worth $9 billion when we published our book, Blockchain Revolution, in May of 2016. Had the whole market been a publicly traded company, it would have barely cracked the Standard & Poor's S&P 500 index. 2 years later, it surpassed $800 billion, in the same ballpark as Microsoft at the time. At its peak in 2021, it was worth more than $3 trillion, greater than any publicly traded company in the world at that time. Today, it's still worth well over $1 trillion. Ethereum's inventor, Vitalik Buterin, asked an important question: has the digital asset market earned this value? Vitalik asked, how many unbanked people have we banked? How many other global problems have we solved using digital assets? Yes, there is a significant level of activity. There's also a lot of hype. For every successful blockchain project and every digital asset winner, there are many that fail. This industry faces some serious challenges. How will the foundational technology scale? How will governments react? To be sure, the digital asset revolution can only happen if we have sensible regulations in place that promote education and hold bad actors to account. Scammers must be punished. People who want to invest need to know the rules of the road. But bad regulation can stifle innovation. Even rules made with the best intentions can have some unintended consequences. In some countries, multiple regulators with overlapping mandates are sending conflicting messages. In contrast, jurisdictions like Switzerland and Singapore have emerged as favorable spots for startups. These small and nimble jurisdictions have capitalized on this new industry. But they still remain the exception, not the norm. For now, the lack of regulatory clarity has created uncertainty. There are many big implementation challenges to overcome. But look beyond the hype and the mania, look beyond the fear and the doubt, and you'll see that something profound is happening. Bitcoin was the first step in a long campaign to create a brand new technology stack for the internet. It is a foundational building block for Web3. Blockchain is the first digitally native medium for value. Powering the digital asset revolution are 9 different digital asset types. The first is cryptocurrencies, aka digital money. Bitcoin is still the mother of all cryptocurrencies with a market capitalization of $416 billion. It functions like cash for the internet and a final settlement layer for the crypto economy. Bitcoin is also digital gold for investors, and it's basically unrivaled in that role. The second type of digital asset is the stablecoin, such as Tether's USDT and Circle's USDC. These are digital assets with stable value pegged typically to the US dollar. They now have a total market value over $142 billion. Stablecoins use different methods to stabilize their value. Centralized stablecoins are backed by deposits of cash and equivalents inside financial institutions like banks. Decentralized stablecoins like DAI are collateralized by crypto assets that are held in smart contracts. A third type of asset is the exchange token, native to centralized exchanges like Binance and FTX. These tokens are essential to the exchange's functionality, and they promote adoption of the crypto exchange. A fourth type are securities tokens. These can be digitally native securities such as decentralized finance or DeFi investment funds, and even derivatives contracts. Or They can be originated by traditional financial firms, such as investment banks or asset managers. The fifth type is the protocol token, like Ether, the native token of Ethereum. These native tokens power DeFi and much else. Other examples include AVAX, the native token of Avalanche, and Sol, the native token of Solana. Sixth are governance tokens, such as Uniswap's Uni, Compound's Comp, and Yearn Finance's YFI. These give holders a say in the governance and specifically in the allocation of resources from the common wallet of decentralized autonomous organizations, or DAOs. Seventh are non-fungible tokens, or NFTs. NFTs are unique, provably scarce digital assets. They provide a means to verify the scarcity, provenance, and ownership of these assets. They are commonly used for digital art and for collectibles, but they can also represent physical assets, such as sports memorabilia and luxury goods. The eighth type is the natural asset token. These are digital assets backed by real-world commodities, such as oil or gas, land or carbon. The ninth type of digital asset is the central bank digital currency, or CBDC. CBDCs are crypto versions of fiat currencies, such as China's digital renminbi and Nigeria's digital NAR. We'll look at each of these assets in depth. On behalf of my co-instructors and our academic partner INSEAD, thanks for joining us. If you have any questions or comments, please post them in the discussion forum. We'd love to hear from you.